All right, we're back. The March episode of the Mortgage Show. A lot to talk about. Do you want to start with interest rates, or do you want to talk about the big news that we had last week?
Let me do this. Let me not take over and let you do your thing. Sorry.
I'm fired up about interest rates. We have a lot to talk about there too. But I think the big news that's been on everyone else's mind is the NAR settlement announcement that came out Friday, late afternoon.
Yeah.
I think I did I message you maybe on Instagram late in the day, but I don't think we talked, and then maybe we texted over the weekend and stuff. But when did you hear about that news?
Yeah, it was random. It was like Saturday morning, I think, right? Because it was late Friday night that came out, and it's like I read through a lot of it, and it's just it's spinning in an area where I wonder where we're going to go from here. Like, what's going to happen with all of this? And we've had so much change in our industry. Is this the first kink in the armor for the real estate agents? I don't know. Like,
Yeah.
yeah, I don't know. What's your thought on it?
Well, when I first heard about it, I was like, wow, that's pretty big news to drop on a Friday afternoon and give everybody the weekend to kind of just digest it and have their wheels turning, which I don't know. I don't think it's that fun. It would be probably better if it came out early in the week where people could talk about it. You know, you can write stories about it, but once it goes into the weekend, it kind of dies because everyone gets busy with their lives. So I was anxiously awaiting to hear what everyone said this week. And like you said, there's been so much change in our industry. So I think that that's part of the deal for us. We just assume that there's going to be some level of change on a year-to-year basis every few years, and we just kind of adjust. And the people that are professionals and do a good job are going to find a way to be successful either way. But it was interesting to see this change on the real estate side because it does seem like it's an even bigger change than some of the stuff that we've gone through before in our business.
Randy, man, it's like the market dictates a value. There's a commission that's been paid out. You
Mhm.
read through this and it's just like how weren't a group of sellers not realizing where commission was going? You know what I mean? It's just such a fascinating thought process to me that leads me to this area of like who's benefiting from this? And it's
Yeah,
like, are the attorneys?
of course, of course.
You
What
know?
I was hoping to do is I just want to give a real baseline, like high level description of what this is, just so we
Yeah.
can get that out there. I want to share what some of the people that I've been talking to have been saying because I've had a whole range of feedback on it, and I'm sure that you have too. I would love to be corrected if anything that we say is incorrect or if someone misunderstands us. I mean, definitely, we're not realtors, so I wouldn't want anyone to think that we are. So there's a possibility that we're getting things wrong, or you've heard from your legal counsel or your leadership something different than we're going to say. But as far as what I've heard, I would definitely want to share that. We have a guest coming on, our guy Kyle Keagan, our market manager with Norcom, to talk about how these changes affect the lending world. So he'll be on in a little bit. But that's the plan for it. We're not going to spend the whole episode talking about it, but we do want to share some of the thoughts that we got on the front end of things. So, high level beds, maybe I'll start. You can jump in. But
Yeah.
like you said, some sellers sued NAR, didn't realize that they were paying the buyer's agent's commission out of their side of things, right? They didn't like that. They sued NAR. It seemed like this was far from being settled. Then all of a sudden the settlement came out. I think it came out a little bit quicker than everyone said. But basically, sellers are not going to pay buyers agents anymore, or that's not going to be advertised in the MLS. And buyers are going to be free to, or not free, but they're going to have to pay their buyers agents themselves now. And that's a big change for the market.
So when you say they didn't realize that they were paying the buyer's commission, it's like, but you guys, you realized that you were paying a commission. You agreed to a commission structure. The majority of sellers already agree, they negotiate. Everybody negotiates. It's like
Yeah.
when you signed up with that listing agent, their odds are that they negotiated their commission. So it's like, why does it matter where the split goes?
Yeah.
And I think an answer to that is it actually matters quite a bit because the market, there's another side to the market where you have a bunch of buyers agents representing these buyers, bringing you people willing to buy your home. So it's like, what's wrong with this progression here? You know what I mean? That's where I'm spinning on this.
They do talk about 6% being the standard, and it probably is, but I feel like I've seen plenty of 5.5% listings, some 5% listings. There are some more budget, like 1% on the listing side, listing agents that'll still get a buyer's commission. But so it does seem like there was room to negotiate with that stuff to begin with, but maybe it's just different in different parts of the country. And
Yeah,
now they're setting a standard that applies to everybody.
dude, it's an interesting area. I know that I'm saying the same thing, but it's like,
Mhm.
where are we going with this?
Mhm.
How is this going to look moving forward? Are we going to introduce mortgage products that allow buyers to finance commissions for real estate agents? I don't know.
I don't know how that would work. And that's one thing I want to talk about with Kyle, because that's one of the questions that people have had for me. But let's talk about some of the feedback that you got over
Yeah.
the past few days. Cause I know this has been a good opportunity for us to connect with our referral partners, realtors that we do business with, get their thoughts, see how we can support them. I've had people that say in the state of Maine, this is how business has been done from the beginning or for a while, so that it's not going to have much impact on Maine. Some people say it's business as usual. Some people say this is going to force agents to be more articulate and selling what they do to get buyers to understand they have to pay the buyer's agent fee. But what have you been hearing?
I'm taking a lot of information coming my way is really just creating the thought for me that a lot of people are just going to have to be more articulate with how they explain commission splits and where it goes and why it's going where it goes. And I'm getting the feeling that a lot of people aren't afraid of that. It's actually probably more comforting to have people knowing where it's going and why it's going. Maybe it's a layer of full disclosure. And, I mentioned some of the changes in our industry, back in 2011 with some compensation rules. It really kind of, I don't know, brought our industry to an area where full disclosure is very, very prevalent. So maybe this is just one layer more that makes their job easier, maybe.
Yeah,
I know
for some people.
Yeah, and
The thing I fear is that like newer agents that like how does an agent, because we work with younger agents, we joke around how like we're getting older and it seems like a lot of the agents are getting younger and younger, but like there's plenty of 20 something year old agents that are very new, they look young. I fear that they may have a hard time or not have the confidence to be able to sell the services that they're providing to buyers to demand their fee, because now the buyer is going to have to pay them their fee. It's not going to come from the seller. And there might be ways that we can talk about how the seller does ultimately pay it, but like in theory, if this law comes to fruition, those people are going to have to say, hey, Mr. or Mrs. Buyer or Mr. Buyer, you're going to have to give us a 2.5 or 3% commission. That might be hard for some of those newer agents that don't have 20 years worth of experience to draw on, and I worry for them.
I think there's a confidence level too when you're coming in with, say, 10, 15, 20 years of experience explaining why a big chunk of money like this is going where it's going. So I think there's an age thing there for sure. I don't know if you're a young agent walking in with that confidence, or what does it look like if your sellers are a little bit older, you're a younger agent, and this younger agent's just like, hey, we sell this place for 600,000, here's the commission splits. It's probably going to create a lot of looks and a lot of questions for that young agent. It's maybe an assumption on my part, but
Yeah.
I don't know.
I have that thought. And I don't know. It probably is the wrong assumption, but that's like my first thought. If I was new and then I had to tell someone they have to pay me 2.5% to show them a home and do all the things that come along with being a realtor, and there's plenty to it. I wonder if that pushes some of those younger, more inexperienced agents out of the business and leave. It's probably not a bad thing, I guess, for some people would say, but I could totally see that happening.
What about the confusion that it's actually going to cause on the buy side for agents? I mean,
Yeah.
we're talking about young people. Young people are usually the ones buying houses, unless you got your repeat buyers and stuff.
Mhm.
But like if you're young buyers looking at this, it's like I bet it can be so overwhelming to think, where am I going to come up with 3% of $500,000, 15K outside of my down payment that I need to come up with? Like,
So let's walk everyone through something. First time home buyers that are trying to do minimal down, let's say conventional loans. Let's say you do a $500,000 home. The minimum down payment's 3% on that. So that right off the bat is going to be 15K, and you need another 10K, let's say, of closing costs. So to buy that home as a first time home buyer, again, minimal down payment, you need $25,000 in the bank. That's a lot of money for people, right? Like if you're saving, even if you're saving $500 a month or $750 a month, that's years worth of savings to get to that point. So people have to work hard for that if they're not getting a gift or if they're not selling a house and have a bunch of proceeds. So to say, hey, you have to work hard to save $25,000 to buy your first home. Now add another $15,000 to that for a 3% buyer's commission fee. It's like now you have to work hard to save $40,000 to buy your first home. Dude, that's like a freaking 5-6 year long process for some people and can be very discouraging. So I feel bad for those people.
I'm afraid that this lawsuit is like catering to like that 1 to 3% of the demographic that's actually upset about
Mhm.
what the result of this lawsuit is bringing to us. And it's like 97% of the people are actually affected by this now.
Mhm.
And it's a
Mhm.
big part of it is the buyer side actually. So I don't know. I don't know. I'm kind of hoping this stalls out, to be honest with you. But
That
for
is
a
another thought. That's another thought because this isn't a done deal. This is supposed to go into effect what, June or July,
yeah,
and this has been agreed on by the parties involved, but it hasn't been signed off on by a judge. So when you try to think about how this helps the industry or who this helps, like, does it really help anyone? Does this really get signed off on? So I guess that's the other shoe to drop, whether or not it gets approved.
something random is like since I've been sitting in this chair, you add a layer with the AMCs for appraisals, so that added more cost for borrowers, right? So the cost of borrowing went up. Behind the scenes, you have some LLPAs, and there's a certain amount of that LLPA that goes to the quote unquote general fund. Basically, it's another tax on the consumer. And now you take a look at this. You know, it's granted it's not increasing costs in my random ramblings here, but it's like it's just another layer of things just getting a little harder for no reason, in my opinion,
Yeah.
which is kind of annoying. But
One person mentioned they thought this was the fact that I don't want to get political about it. I don't think we have to, but just the idea of the DOJ taking this lawsuit and kind of pushing it forward was I'm trying to stall out or let's say slow down the demand in the housing market a little bit.
yeah,
I thought that was just an interesting take because I could really see it slowing down demand. Whether or not it was intentional, I guess we'll probably never know. But I do think it could slow down demand for that first time home buyer market and take some people out of the market that otherwise would have been buyers. And we'll see how it all plays out.
yeah,
A couple things I'd want to mention. You still can have seller concessions to pay for these buyer agent fees. So assuming this doesn't change, I would expect that one thing that we'd see that's been pretty common over the years, not so much in the past couple, is a buyer making an offer looking for seller paid closing costs that they could turn around and use to pay for their buyer agent commission. So
yeah,
one of the things that we'll talk about, I guess, in a bit, I still don't want to jump to it just yet, is just the different programs and what the seller concessions are that go along with those. But in
yeah.
theory, you could turn around and use that money to pay for your buyer's agent commission. So I could see that coming back. What do you think?
Yeah, I could see that coming back. And I wanted to ask you because you've had some experience working with assist to sell scenarios.
Yeah.
Isn't the assist to sell model basically a fixed seller cost, and any buyers that come in sort of negotiate
Yeah,
a
it's funny. Cliff or Tim or someone else would have to comment on that, but I do believe that, like, yeah, it's a lower fixed cost for the sellers, maybe 1% for selling the home, but like if a buyer came in, you could still negotiate a more traditional type
commission?
commission. Hmm.
Does is that sort of the organic progression of this? If this actually does become the new norm, you
If it
know,
reduces the costs.
yeah, I started thinking about that. Is that just basically how it's going to go? At the end of the day, everybody's going to explain this, and buyer agents are going to work with their buyers, and at the end of the day, they're just going to ask sellers for a commission
Yeah,
outside of
probably.
closing costs. Yeah, probably,
Yeah,
right?
probably. Yeah, I could see that shaking out that way. A couple other things I should mention is with VA loans specifically,
Yeah,
VA loans do not allow for buyers to pay real estate commissions. It's just not even allowed. Like, you, even if you wanted to, even if you get the seller to pay for it, it's just
yeah.
not allowed. So something's going to have to change with those type of loans. Like, it honestly has to change in conjunction with this law almost, or we just won't see VA loans anymore, which would be a shame because they're the best loans out there for people that qualify for them.
It's funny too, with this lingering in the background, you normally in our industry, you'll start to get some whispers of what might change or may not change, and like I've heard nothing, man, which is
Yeah.
really weird. It's
I've heard
it
people
look
bring it up, but it's not like I've heard, hey, there's murmurs that VA is going to make this change. But I
yeah.
know realtors are asking about it. I know people are asking about it, and there would be no way to pay a buyer's agent. It would just not allowed if someone does a VA loan with the rules that we're talking about changing.
So with that said, it's like throughout the changes that I've witnessed since I've sat in this seat, it's like the layer of this being so quiet of any change on our end. It's like, are people actually, is our industry actually worrying about this going into place? I don't know.
Yeah,
Makes me wonder. Makes me wonder.
I'll be interested to see what Keegs has to say on that. I did have one person tell me that this change might be the thing that pushes them out of the market, might make them retire. So that was an interesting thought for me. Because again, there's some people that say it's business as usual, but then this other person was like, I think I actually might retire now because they think it's going to be that difficult to do business with buyers. So it was an interesting thought that just shows you that everyone's different and everyone has different reactions to things. But
Sometimes I wonder with that, Randy, if that's just the little bit of the needle moving mentally to just
Mhm.
finally force you to an area where you want to be anyway,
Yeah, yeah,
regardless of that news, you
just
know?
looking for an excuse. Which, hey, good for them. That would be awesome for them to be able to retire. Ultimately, I mean, we'll see where all this lands, but it was definitely big news, and wanted to bring it up on the top of the podcast because it's the thing that everyone's talking about. And honestly, in 2 days from now, everyone will probably be even more sick about talking about it than they already are right now. But I think it makes sense, since we had the podcast coming up today, regardless, to spend some time on it. So, do you have anything to add before we move on? And obviously, we'll bring it back up when Kyle is on the phone or on the pod
Well,
with
it's
us.
gonna. I was just thinking, Randy, it's gonna be interesting in like a couple of months where we're talking about this again, and will it be like, wow, that was a concern for like 33 seconds,
Yeah,
or holy cow, this is what it looks like.
like it's really, yeah. We'll be interested. We can definitely keep talking about it on the pod for months to come. So I think that's all I have to add on that front right now, and I think we should move on if you're cool with that.
Yeah, let's do it.
Let's talk about interest rates. Today's a big day,
Yeah.
Fed day. They're talking about what they're doing with interest rates. So why don't you give me an update on that?
Some higher inflationary numbers last week, but really not that elevated. Just enough though to kind of spook the market just a little bit. But it seems like, in the short term, interest rates want to go down. Every now and again, we have some blips. Last week was the blip, and now today we have the Fed news. It was thought that maybe the Fed was going to lower the prime rate. They decided not to, and
Mhm.
I think that was a direct result of some of the higher inflationary data last week. So they're still looking to cut three, is what some of the notes just said.
Three
Maybe
times this year.
three times this year.
It had previously been four times. So that is an adjustment down. So that's not necessarily good for rates. But what else did they say?
They're thinking fewer cuts in 2025 also. So
Not good for rates either.
not good for rates either. Though, I want to put a positive spin on this is because for the last 2 years, we've been sitting in these chairs just every day watching these interest rates just shoot higher and higher. And we've got these little, lows where we're like, okay, maybe this is when it's going to turn around. I could definitely tell you the feeling that I get after all these years watching trading and sort of watching this economic cycle now. It's like I finally feel like we're in the area of they will be heading lower. It's not like we're going to have that 8% run that we had in October, thankfully. And I'm starting to spin on that thought of comfort because it's like retail sales, some manufacturing numbers, which are like strong indicators of how the consumer is doing. Those are starting to stale a little bit, and that usually leads us to a little bit of a downturn in the economy and
Yep.
lower interest rates. So I think we're at the ground floor of actually finally being in a more stable to lower interest rate environment.
I don't think anyone expected that rates would get cut today, or the Fed funds rate would actually get cut today. I mean, they just confirmed that it didn't, but I think I've heard some people eyeing like the first cut happening by June. That would be nice. But good news is they lowered the expectation on cuts for this year, lowered expectations for cuts next year, didn't cut the rate, and still the market has reacted in a pretty stable way. It hasn't, a lot of times it's hard to describe, but mortgage interest rates are very market driven where they fluctuate throughout the course of the day. Sometimes they fluctuate so much that we have to change the interest rates in the middle of the day. So a lot of times in the past, announcements would come out like this, and we could look at a chart in real time and see the market move right before our eyes. That isn't necessarily happening today, right?
Right. And I think we should mention something because we're talking about mortgage interest rates going down and we're sort of connecting it to the Fed. So
Mhm.
the Fed funds rate, guys, is an interbanking lending rate. So if Randy was a bank and I was a bank, this is the suggested interest rate that we should lend to each other. And then there's some VIG put on top of it. And then the money is passed on to the consumer when they borrow it. So how it affects mortgage rates is usually when you're seeing prime lower, that's basically the Fed acknowledging, okay, the economy is starting to stall a little bit. The cost of borrowing needs to come down to spur some economic activity. Organically, mortgage rates are going to like that news and follow along with it. So just kind of want to separate that because, Randy, how many times have you been asked, did the
Hey,
mortgage rates
The
look
Fed's cutting mortgage rates today, or the
Yeah,
Fed's raising mortgage rates today. Yeah, and
yeah,
I
yeah.
don't think we could ever say that enough. I Until everybody fully understands that, we should keep saying it. I don't know that that day will ever come.
So I like interest rates in the short term going down. We'll see what
Mhm.
happens.
Yeah, but definitely not the worst day for rates today. So stay tuned. We'll keep you posted on that one. Do you want to move on to some underwriting tips?
I do. I want to say that I just stalled there for a second because Haley's been trying to call me like 27 times. And I just sent her a text message. No, I just sent her a text message shooting a podcast. You okay? She's like, Dad, I'm okay. I'm overreacting to something. You could call me back.
Let's get her on the call. Let's get her on the podcast. Um, I'll
Um,
be ready for those type of calls in
oh,
like
man.
any time, actually. Okay, so underwriting tips is kind of the fun part of the podcast for me because I like sharing underwriting tips, educating whoever listens on some of the things that we're seeing on our side of things.
Yes.
And beyond underwriting tips, these things again that we're dealing with on the lending side, there's a few things that we'd want to share with our realtor friends, give them some knowledge that they could use in their business to educate them on the lending side of things as well. So for underwriting tips this month, a couple things that we want to run through. First is the idea of using 1 year of tax returns to qualify a borrower that's self-employed.
Yeah.
Oftentimes that we say you need to have 2 years of tax returns, 2 years of tax returns, 2 years of history, all that sort of stuff. But there is a unique situation where you can use 1 year of tax returns. Why don't you talk a little bit about that, Beds?
Yeah, guys. So the loans that we offer, the qualified mortgage ones, are through Fannie Mae and Freddie Mac. So Freddie Mac has a variance to the 2 year average where if a borrower has filed a Schedule C tax return, a self employed tax return in their industry for at least the last 5 years, and this is findings dependent. So when we run our loans, it's got to be good variables. Down payment of 10% or more. The FICO score needs to be over 700, I've typically noticed. So if you have that down payment, the FICO score, and you're a self-employed borrower, Freddie Mac software will give us the findings where we only have to average the most recent tax
Yeah.
return. So which is a nice thing for us because let's say a borrower was injured, something happened in the economy, and 2 years ago's tax return was,
COVID.
yeah, COVID was a big example. The 2020, 2021 tax returns compared to a year later. But anyhow, guys, most recent tax return actually takes away that lower 2 year average because you could throw that bad year out. And it's a pretty nice wrinkle that we have.
Yeah.
Not a lot of loan officers know it. So nice little benefit for self-employed people.
Yeah, it is awesome. It's sneaky because, like we said, it only makes sense if the borrower has been in business for 5 years. So that's a big thing. So I talk to people all the time that just started a new business, and it's like, when can I use this income to qualify? In that situation, you need 2 years of tax returns. If you have less than 5 years of history, you need 2 years of tax returns. But if you had a auto shop for the past 20 years, but 2022 was a bad year, no problem. We'll just use 2023. Show you've been in business for over 5 years, and boom, it works. And again, like you said, if there's an injury, health issue, life event, COVID, bad year, this is a way to get you into a home with better numbers. So
And man, I know that we didn't prep for this, but one thing that I get asked a lot is like, let's say you're a W-2 working in a garage. So you're a mechanic.
mhm.
And so you've been a mechanic for 20 years working for somebody, and all of a sudden you're taking over the business or you're opening up your own business. You're like, Chris, I've got 20 years of history doing this. Well, you just started self-employment 5 seconds ago. You actually don't have 2 years of self-employed history in your field. So that's actually a huge thing. I get questioned on that all the time.
It happens more than you would actually think if you're listening to this and not knowing, because man, people switch that direction all the time. It's a lot easier to go self-employed to being a W-2 employee. Boom, use your income right away. But when you go from being a W-2 employee to self-employed, even if it's the same industry, there's just some nuances and some things to work through. And you can make it happen with a year's worth of tax returns there, but there's some different requirements. But so that's a good one. Keep that in mind. Anything else you want to add on that one before I move on to the next one?
Yeah, I should say something real quick is like Randy transitioned pretty quick from self-employed to W-2. One of the things that we do see on the findings, so if you do make that switch, more likely than not, the software is going to tell us that we want 30 days of earnings. So
Mhm.
it's usually a 1 month thing, and then we can fund a loan.
Yep. Thanks for mentioning that. Next one I want to talk about is identity of interest. Do you want to
Yeah.
explain what identity of interest is?
Oh man, that's just a scenario where you've got a business relationship with a transaction, a family relationship with a transaction, and
And
that actually changes some of the loan to value factors.
so this is with an FHA loan specifically, we should say. So if
Yep.
a borrower is doing an FHA loan, buying a home from a family member or someone they work for, there are some loan to value ratio changes. And again, I should say the normal loan to value ratio requirements is 96.5%. So you basically 3.5% down payment is what's required for an FHA loan in general. But talk about how it's different when it's one of those family business relationship type things.
Yeah, so it changes the amount of down payment, guys. So Randy was just mentioning 3.5% down. It actually kicks it to a 15% down scenario right away. So that's
Mhm.
something that needs to be considered on FHA loans if there's an identity of interest. Huge, huge thing to pay attention
Yeah,
to.
it sneaks up. Yeah, people just think, hey, I'm going to buy a home from my aunt or whatever. She's selling her home, and you need to have 15% down. So 15% is a lot of money for most people that are looking to do an FHA loan. So it can be a little bit tricky, but there are exceptions to this rule. So why don't we run through some of those? Okay, beds.
Yeah, let's do it. Go ahead.
Let's see. So there are exceptions. Family member purchases the principal residence of another family member. So if it is their primary residence, that's one way to be allowed to do 3.5% down. Another one is if the property is owned by another family member, the borrower has been renting it for 6 months, though. That's okay. The 6 month piece of actually living there kind of takes that off the table.
Yep.
As far as a business employee purchase, if an employee is not a family member of the builder and the purchase is a primary residence, you could still do 3.5% down. Tenant purchase, if the buyer was a tenant of the property, again for 6 months, they could buy it with 3.5% down, even if they're family. And then there's a corporate transfer. So if a corporation transfers an employee to another location and purchases their home, they can sell it to another employee as a primary residence with 3.5% down. So that one's a pretty specific situation, but there are ways around this.
You absolutely just dominated that.
I don't know that I dominated it, but just read it off the list. So keep that in mind. I guess the first thought, if I'm a realtor, is just like if you have a buyer that is buying a home of someone that they work for or as a family member, just kind of keep that in the back of your mind to let people like us know to work through the list of exceptions or set the right expectations with people. But I can see it slip through the cracks. I've seen it slip through the cracks before.
It's funny. I got a smile on my face right now because all I'm thinking right now is this is an issue if the family member or the business relationship, if they're cheapskates and don't want to give a gift of equity.
Gift of equity we should do next time because that's a nice sneaky little trick to make things happen.
Noted.
Okay, before we bring Keegs on, tips for agents this month.
Yeah.
Because of what we were talking about before with the idea that sellers could pay for the closing costs for borrowers, that could include that buyer's commission. We
Yeah.
want to talk about what is allowed for the different types of loans when it comes to concessions, because it's not the same thing. There are limits to what you can ask for as a buyer from a seller, depending on the type of loan that you do. So why don't I tee some of them up for you, Beds, and you tell me what they are. Okay. So conventional primary or second home, if you are doing less than 10% down, what's your max seller concession?
That one is 3%.
Which would cover a buyer's agent commission. So
Yep.
3% seller concession with 10% down or less. What if you're a buyer that's putting 10 to 25% down?
So that bumps up guys to 6%. So that could sneak in some commission. That could also pay the closing costs.
Yeah. And then this one kind of surprised both of us when we were talking about it the other day. But if you're putting more than 25% down, you can actually you can get 9% seller concession, which is way more than you would ever need for anything.
Let me tell you, almost 20 and a half years doing this, I am not excited to admit I had no idea it was 9% if you put 25. Because like how are closing costs 9% of your purchase price? You know what I mean?
And if you have 25% to put down, you're not asking for seller paid closing costs. And
No.
there's just not even enough closing costs to pay anywhere near 9%. Even 6% would be hard. Especially 9% on a on a $500,000 purchase is 40 something thousand dollars. It's just closing costs would probably be 10 grand in that scenario. So anyways, it's kind of silly. I would love to know what a use case is for it, but that is what it is. If you're doing a conventional investment property, what's the max seller concession?
So let me ask you a question.
Mm-hmm.
Has this caught you before? The
It's
answer
been
to
a while.
this.
It's been a while, definitely. Dude, like so many things in this business, it isn't a problem until it's a problem, or it doesn't catch you until it catches you. And there has been times this came up in the past.
Yeah, so guys, the answer is 2%. And the reason why I asked Randy this is like, oh man, when you get a conventional investment property, normally people are using their own money. Normally they're not negotiating closing costs, but every now and again you'll get, and I think the thing that's tripped me up in the past is like 2% of, let's say and this number's crazy, 200,000 is the investment property.
Mm-hmm.
So your max seller contributions are $4,000 for the buyer.
Yeah.
You know what I mean? It's like, closing costs on 200,000 is probably going to be in the 6,000 range. you estimate the closing costs, the real estate agent dominates it, gets the 6,000, I get the contract, and I'm like, oh crap.
It's happened before, dude. I mean, it's
Yeah.
definitely happened.
Yeah.
But
So yeah, 2% is the max on an investment property, single family to 4 units.
yep. So, all right. FHA and USDA loans, what's the max?
6%. So here
Which,
we are again in an area where you could get closing costs and maybe commissions.
yeah. And then VA, last one is 4%, a little bit lower than the other government loans. But again, this cannot go towards buyer agent commissions, just the closing costs, which would be enough to cover all that.
VA's got some sneaky guidelines that lean severely towards the borrowers.
Yeah.
Yeah, that's 4% there on that one. I mean, man, I could rattle off some VA stuff. But
Do a VA pod someday. Yeah, dude. So that's good to know. If you're an agent and you're still listening to this at this point, keep that in mind when we are figuring out asking for seller concessions to pay for buyer agent commissions in the summertime. Yeah, absolutely. Because we get the man coming on in a second. Why don't we break for a sec and then get Keegs on the pod? All right.
Let's do it.
All right. We're joined by our man, Kyle Keagan, market manager with Norcom Mortgage out of Connecticut. Thanks for coming on the podcast with us.
Oh, always, man. I love this. Love you guys.
We were just talking about how quiet of a week it's been in the real estate world. Like no real news. You know, rates have been great. Just a ton of people going under contract. So
yeah. Just par for the course right now.
Hey, ton of refis right now.
Ton of refis.
Refi game. Yep.
So life's good, dude. But really, there was a big day on Friday. Me and Bez talked about it. It's not going to rehash it, but NAR settlement, big change in the real estate industry, and we've had the whole gamut of like reactions to things, and we can talk a little bit about it. But the thing that people keep asking me and probably Bez is just like, how's the lending world going to react to this? Like, what are lenders going to do to help buyers out to pay these buyer commissions? I don't know that you have the answer to it, but like, have you gotten that question? Have you heard that thought?
Yeah, we have gotten that question quite a bit. I think the news of this settlement was huge news. That number, $418 million, it's a big number, right? So it created some chaos. It created some uneasiness in the industry. You know, I think there's so much yet to be seen about what these changes are going to be, what the proposed changes will be, and what eventually will happen. I think in our industry, on the lender side, you guys know it's tough right now for first-time homebuyers, right? Between affordability, inventory, I mean, it's really tough right now. And the way these changes are reading, it seems like it would land a lot and affect mostly that borrower. You know, first-time homebuyer, how many are you working with that have easy 3.5% to put down, let alone 10, 15, 20%, and they could absorb that new cost that they're going to pay their buyer's agents? I think buyer's agents are important. They're certainly important to our business, but they're important to the buyer, right? They're making the biggest financial transaction of their life, most likely, and having someone there to represent them and help walk them through that is an important step. The seller's agent is there to represent the seller and get the best possible deal contractually for the seller. So having that on the buyer side is important. So that's my concern, is that it lands on the first-time home buyer who right now is having enough trouble trying to get into a home. I don't know what you guys discussed earlier, but that seems to me where we're going to have to make sure that doesn't negatively affect the first-time home buyer.
It's interesting, Keegs, because like some of the changes that we've experienced in lending, there's always been a big lead up to here's what we think we're going to do to sort of evolve around the changes that we've had. It's interesting, like nothing has come out, any whisper or anything to help out a buyer on the lending side that I've noticed. Have you noticed it?
Yeah.
Yeah, nothing, right? So it's almost like there's no concern that this is actually going to go through.
I wonder if Fannie Freddie gets surprised by that settlement on Friday, because there's certainly nothing in the guidelines that allow for us to just say, oh, hey, borrower, you need 3% for your buyer's commission. Oh, let's just tack that onto the loan. That doesn't exist. Like the amount of money people borrow in relation to the purchase price is like a very specific thing. You can't just have a first-time home buyer that's putting 3% down and then we turn around and give them 3% for a buyer's agent commission. Just in that case, they'd be borrowing 100% of the purchase price, and that's not allowed. So like that has not come out. I don't know that it ever would come out, but I do know that there's some agents that are like reaching out and being like, "Is that going to be a thing?" It's like I don't know that that's going to be a thing. I really don't.
Yeah, it's kind of a very reactionary industry we're in to begin with, right? I mean, I feel like maybe it did catch them off guard, but that would surprise me because there were rumblings and rumors of this coming down for a while now. So it would surprise me that it totally caught them off guard. Maybe they have something in mind where, you can finance that fee at a low percent. I don't know, but tacking on another finance charge onto the consumer, it kind of goes against the whole purpose of this, right? I mean, I don't think the answer is to just throw it on and just finance that in as well. I think sellers are going to continue to have that option, right, to pay for the buyer's agents, whether they negotiate that down and that becomes the big thing. That may be it, but I think we're going to see a lot of sellers that continue to offer to pay that. If they all of a sudden have an open house and they're no longer getting anyone coming through because they're not offering anything to a buyer's agent to incentivize them bringing buyers in, you can see it kind of being this big announcement and then it continuing to just kind of move as it has been. That wouldn't surprise me either.
Yeah.
A couple random thoughts that I have is like if you end up financing it, everything in our industry is LLPAs, which are those risk assessments to interest rates. So it's like another variable you have is appraisal. So how are you going to figure that out? Are you going to then adjust the LLPAs, which is going to be another cost to a consumer? So it's like everything is leading down a path for me of like, man, we're just affecting things negatively for no reason. Again, why are we doing this?
At a time when we're desperate to make it better, right? We're desperate to get inventory up. We're desperate to get affordability. We're desperate to get first-time home buyers into homes. We don't want to lose this dream of home ownership. And it feels like it's getting really tough for these people. We had someone recently, a career mechanic who makes $80,000 a year, can't get into a home, can't find a house that he qualifies for. And that's insane. That should not be the case. Someone who has great work history, great credit, it's scary. And to think something comes down that will negatively affect that I don't think as an industry we can allow that to happen.
Yeah. I'll be interesting to see what lobbying can even be done against us at this point. It sounds like the settlement's agreed upon and we're just waiting for judges to sign off on it. But I wonder if there's any potential fight left to prevent it from happening. Yeah. I haven't heard that one way or another. I still think people are really digesting things. All the agents I've talked to, it's been like, yeah, we have a Zoom call with our CEO later on today, or our legal counsel is going to be doing a presentation, whatever. And so I feel like everyone's still kind of figuring things out at this point.
Go ahead. Sorry to interrupt you, Kyle. I wanted to add something where I'm starting to wonder, because I brought up the assist to sell scenario with Randy, where it's like, you've got your set listing agreement with your sellers, and then any buyer that comes in typically negotiates that commission to be paid for by the seller. So it seems like this is going to be the organic progression. I'm almost wondering, though, as I'm kind of playing this through in my mind, with the full disclosure process of this, or the over disclosure in my thought process, is this going to make commission a little bit skinnier for real estate agents? Because now you're going to really have to start explaining why that commission split is going where it's going. And will that put heat on these agents from sellers to actually lower those numbers? I don't know. It's been something that I've been thinking about too, outside of this.
Yeah, it'll be interesting.
Yeah, I'm that's a great thought, Bez. I'm sure it will. Coming from this just standard of, when I bought my house, I didn't even really understand what was going on, and I'm in the industry with what the realtors' commissions were. I used the seller's agent as my agent as well. I know a lot of states don't allow that, but you could see that becoming in the states that do allow it, something that they try to capitalize on.
Well, hey, and actually, if you think about that, so that's disclosed dual agency. If you are in a scenario now where more buyers are going directly to the listing agent, isn't a seller going to put more pressure on a listing agent to lower the commission? So you're almost doing double the work now.
Yep.
You know what I mean? For only that,
you're not truly representing the buyer in those scenarios. I mean, I know you're doing something, but it's just a weird situation.
Yeah, that's the thing. You're representing the seller.
Mm-hmm.
How do you can't play yourself in chess, you know?
Yeah, that's a great way to put that.
That is true. You cannot play yourself in chess. Well, you could, I guess, but
you try. You're trying harder with it.
One of the things I guess I would want the people listening to us, like referral partners, realtors, like just know that like we're on top of this. You know, this is a fluid situation. I know the peeps at Norcom Home Office are following this too, and as things get more clear and we get notified of things, we'll obviously find ways to help everyone out as much as we can.
Yeah, absolutely. We've always been, great partnerships we've had with buyer's agents. You guys are the prime example of that, right? And as a company, you're right. We stay on top of the news. We stay on top of compliance. So we'll figure out on the lender side what we can do to alleviate any pains that come from this within the legal scope of things.
Yeah.
But yeah, I think it's going to take some time to settle in and people to realize what the change is. There's a lot of speculation out there, both sides, right? You go online and start going down some wormholes. It's pretty wild what position people are taking.
I will say it's funny because on the market report I sent out to some agents today, I made a comment about, it's a serious thing when like my mom asks me about it, because it has like broken through this level of, normally like these industry changes, like stay within the industry and realtors, everyone's talking about it. But then like other people start texting you about like, what's this NAR settlement, all that. And it's certainly at that level right now.
Totally. It made its way out of like the housing wire and onto Fox and CNN. And, it's definitely hit the mainstream. So, which has honestly helped because when you explain it to your mother, I explain it to a friend who's outside of the industry, it helps kind of make you stop and explain it to the layman instead of talking about it as we talk about it. 'Cause you have to explain it down to the studs.
Yeah.
Hey, and let me tell you, the explanations that I've had with people outside of the industry, after I'm done talking, I'm like, Jesus, I'm exhausted. They don't get what I just said.
Here's an article.
Yeah, there you go.
I've had plenty of people forwarding me podcasts, people forwarding me articles, and I'm probably done talking about this after this week, but it seems like it makes sense to bring it up now. Beds, I have nothing else to add unless you did, but I did want to pivot to something afterwards, but do you have anything else you want to add, Beds?
No, I'm good. I think we covered it all.
So, Kyle, you're going to have to come up here this summer. I'll set the table for this because you got a little portable pizza making situation called Let's Dough. Love the name. We're going to hopefully have an event at the office, which we'll share later on, but like would love to have you come up and make some pizzas. And
it's fun, man. Let's do a little wood-fired pizza oven. We do a good job. So I would love to come take over the parking lot there and do a little event.
Hand some stickers out.
Absolutely. Koozies, stickers, whatever you want.
Try some Hawaiian pizza.
Yes, sir. You know it.
So anyone listening, you got a chance to meet our man, Kyle, this summertime, have some pizza. We'll all look forward to it. Sound good?
Yep. Sounds great.
Thank you for coming on, man. I appreciate it.
All right, boys. Take care.
We'll do it again. All right. All right. Always nice to have our man Kyle on the podcast. He's the man.
He is the man. He's been good to work with, guys. I don't know if we sort of explained what he does, but he is our market manager. If anything is going on with any transaction or anything with our branch, he is the person. He's a big advocate for us. He's our everything, basically.
Yeah. And you may have seen him at events we've had in the office or things that we've sponsored. He usually comes up and supports us. So we appreciate all his help and the help that Norcom back in Avon gives us. So I'm glad to have him come on and talk a little bit about some of this stuff that we get going on, hear his point of view, and get a chance to profile something that's super important to our business. Anything you want to close with, Beds?
I just hope this is adding value for our referral partners. I'm having a good time doing it. I'm appreciative of the ones that are actually giving me some feedback. So thanks to everyone that's listening. It's a lot, man, to put ourselves out here and actually talk about what we do. you know?
Yeah.
So
Yeah, it's fun, man. We hopefully get a little bit better every time. And we're just, obviously, like you said, just trying to provide value to people. So if you guys are checking it out still at this point, we appreciate you.
we do appreciate you. And if you have any thoughts of any topics that we should cover, definitely let us know.
Totally. Let us know what we can do to help you out. So thanks again for listening, and we'll see you next month.
See you guys.